Well, thank you for joining us. Let's go ahead and kick off. My name is Hall Martin. I'm the director of the Texas Entrepreneur Network. And today we're going to talk about a new form of funding called revenue-based funding. Many of you may have heard of that before. For many investors, angel investors in particular, it is a new concept. And we wanted to update you on some new ideas about how this might be applied into the angel funding world itself. So with that, let's go ahead and kick off. As you see in the bottom right-hand corner of your screen, there's a questions box. So we will have time for questions at the end, and you're welcome to type those questions in as we go along. And then at the end, we'll stop and take those questions and answer them as best we can. We are recording this, and we'll be able to place the recording on our website later for your review if you'd like to do so. So what we're going to talk about today is what is revenue-based funding. And we're going to go into basically how it works and in what situation does it work. For which kind of company, for which kind of deal is it a good fit. We'll do a short case study just to put an example out there of how it might work. And then we'll talk a little bit about the benefits to the investor and the entrepreneur. And then finally we'll have a Q&A session at the end. We will follow on with other webinars that will talk about tax implications, talk about how to vet or do due diligence on a revenue-based funding deal, and then how to analyze a deal primarily in the revenue streams in order to understand if it's a good fit for revenue-based funding. So today's session is a fairly basic one that just introduces investors to the concept, and of course we want to answer any questions you have about it as best we can. So let's go ahead and kick right into it. What is revenue-based funding? Well, revenue-based funding, or what's also called royalty-based funding, has been around for a long time. So it's an old method of funding, but we're now applying it to a new market. And basically it says investors put money into a company in exchange for a share of the revenue instead of equity, or it could be in addition to equity. And it's been used in the oil and gas and the real estate industry for many years, but what's new is we're now applying it to early and growth stage companies. And this is coming about for several reasons, and we'll get into that here in a few moments. But I'm an angel investor myself, and I actually started about 10 years ago, a little bit longer than 10 years ago, to do angel investing. And at that time, the mantra among angel investors is that you want 3 to 5 times your investment in 3 to 5 years. And about 10 years ago, when I started doing investing, companies would launch and grow and exit in about 7 years was the norm back then. Well, fast forward to today, and the time to exit on many companies is now almost 12 years. An equity funding structure requires the investor to wait till the company reaches a buyout stage in order to get paid back. And investors, in talking to many of them, want their return sooner. 12 years is a long time to wait for an exit. Investments into startups with equity structures are highly illiquid. It's very difficult to find someone to take your place. There's no aftermarket, or not much of one anyway, to sell those shares, and they're not priced correctly in many ways. And so it's just a tough thing to do if it takes a long time to get to an exit itself. And so I also talk to entrepreneurs from time to time who are a little bit disturbed about how much equity they have to give up for each round of funding. They really want to maintain more ownership of their company. And for every round of equity investment that an entrepreneur goes through, they typically give up 20 to 40% of their company. And over several rounds of funding, the entrepreneur stake shrinks dramatically. Entrepreneurs also want to use revenue-based funding because they want to maintain more control and more ownership over the company that they've built. So basically, how does it work? Well, first of all, the company that you're investing in, if you're an investor, that startup company must have some revenue. Revenue-based funding doesn't really work very well for companies that are pre-revenue or have only projected revenue. Typically, we like to see that the company has raised or generated at least 50 to 100K of revenue since they started the company. After they get from 50 to 100K, they typically have something of a sales track record. It's clear what the customer pays for the product. The customer's happy with the product. There's repeat customers in the process. And as those elements form, you can start to create a revenue-based funding opportunity around the deal. If it's all projections and nothing has been sold, it's very difficult to get to the right answer for those deals. And They just may not be a good fit for revenue-based funding. Investors who come into these deals typically invest anywhere from $250,000 up to $5 million. One can invest other amounts, but we work in the angel world, and these are the numbers that we normally work with our deals. The way it works is the investors put money in and get a percent of the ongoing revenue stream. That's top-line revenue. It's not bottom-line profit. It's top-line, and typically the dividends come back in the form of 3 to 8% of the revenue stream until the investor receives a 2x to 5x, sometimes more return. So 2x means that if 100K goes in, there's 200K coming back out to the investor. And the 2x to 5x is what's called a cap rate. It's the return the investor gets. And it's basically a negotiation based on the risk that's in the deal. The greater the risk, the higher the cap rate that goes into that deal as well. And fundamentally, payments or dividends continue back to the investor until they receive the cap rate. The payback is return-based, not time-based. Many people look at revenue-based funding as a loan, and while there's elements that are similar to a loan is typically time-based, and the payments are fixed, and they must be made at a certain time. With revenue-based funding, one of the main differences is that it is return-based, and payments keep coming until the cap rate is received, and the payments are based on a percent of revenue. So as revenue goes up, so the payments go up. As revenue dips for seasons and cycles, so the payments dip as well. So there's a risk-reward component to revenue-based funding that investors must understand before they go into it. But then there's also very healthy returns that can come back out on the other side. So in what situation does revenue-based funding work? Well, the first thing to look at is the company you're investing in needs to have a gross margin of 40, better 50% margins in order to make this work. If the company is peeling off 3 to 5% of their revenue, what they're going to have is healthy margins in order to be able to do that. So companies with reoccurring revenue work best. Companies with returning customers also work very well. Also, the company's margins need to be increasing as it grows and not shrinking. And we'll talk more about that here in a moment. But in general, it works well with IT companies, mobile, social media, consumer products, low-end medical devices, etc. Anything where there's an established revenue stream and there's a continuing flow makes for a good fit for revenue-based funding. Now, it can also be applied to retail, restaurants, and even lifestyle businesses, but you have to make sure that the revenue stream and the margins are still healthy enough in order to support a revenue-based funding program. So where does it not work? Well, companies with tight margins, those with, say, less than 40%, it's going to be difficult to peel off 3 or 5% to dividend back to investors if your margins are below 40%. It just takes a fair amount of revenue in order to sustain the operation, and of course revenue-based funding doesn't want to hurt the growth prospects of the company, so it's not for every deal that's out there. Also, those with shrinking margins due to high variable costs are not a good fit. So depending upon the fixed and variable cost structure of your deal, your margins are either going to grow over time or they're going to shrink over time due to the cost structure or the competitive nature in the market. And if it's shrinking, those are not a good fit for revenue-based funding either. And finally, companies that don't yet have revenue, such as biotech plays that require FDA approval, they're not a good fit for this as well. There must be some established revenue stream before investors can engage in this in a proper way. So let's look at an example. Let's say a company needs $500,000 to reach the next level of the growth in their company. And say the company has sold $100,000 of product so far, and they have a sales price and a customer base, and it's established, and their gross margin is 50%. Let's say that upon negotiation, the rate of payback is 5%, until the investors receive 3x their investment. Well, typically the payments start anywhere from 3 to 12 months after funding. So after the funding comes in, the money must be deployed, and then the result coming back before the payments can be made back to the investor. Again, the revenue-based funding wants to support the company. They don't want to impede their growth. But so there is some amount of time that it takes to deploy the funds in order to get a result coming back. But once they start coming back, if the company's monthly revenue is, say, $20,000, then the company would dividend $1,000 in the 5% revenue case, and they would do that on each month after the dividend begins. As the revenue increases, so the payments increase, and if the revenue dips, then the payment dips as well. The payments continue until the investors receive 3x their investment back, and if they're raising $500K, 3x times $500K is $1.5 million. Now, many investors are primarily concerned with getting their principal back, and we've seen many deals come through where the principal is at one rate, which is somewhat accelerated because the investor wants to get their initial funds back, and then for the rest of the funds, they reduce it to a lower rate, and so it's not as aggressive. And so the deals in revenue-based funding can be structured to fit each particular situation. There's not one size that fits all, and different investors at different companies have different needs, and so you can adjust these numbers in order to fit your company's situation. So the benefits to the investor is basically the investor receives a return sooner than with an equity structure, because you're starting to dividend out, 3, 4, 5 months after the funds go in, or even a year after the funds go in. In the equity structure, we're waiting for the company to be bought, and that's typically 4 or 5, in often cases more like 9, 10, 11 years before an equity exit actually transpires. There's no risk from not finding a buyer of the company. In a revenue-based funding deal, it is not really a concern if the company is ever bought or sold down the road. It's just, did the revenue stream pay out enough revenue royalty in order to cover the proposed return the investor is going to get. If the company does not grow rapidly, but it does continue to operate, well, the investor still receives the return. And it's often the case that things take longer than originally expected. So if the vision was to pay back 3x in 4 years, but at the end of the 4 years it's not all paid back and you have to go to the 5th or even the 6th year, well, the payments just continue until you get 3x. The investor doesn't get as good of an IRR rate out of it, but they still get the return, they still get the principal, and they still get a healthy return for their investment as well. Now, the benefit to the entrepreneur is they're not giving out any equity, so the entrepreneur retains more ownership and control over their company. There's no discussion about valuation. There's no negotiation about how much ownership is given up to the investors for the funds coming in, and so that simplifies a little bit the negotiation process. And third, and probably most important, is there's no need to seek an early exit for the benefit of the investors. I find many entrepreneurs come in, start a company, grow a business, they like the business, they want to keep the business, but they're being pressured by the investors to sell the business because the return, that's how the investors get their return. If the entrepreneur wants to continue in the business at their own pace, they can do so with revenue-based funding because there's no need to sell the company for the investors or either for the entrepreneurs. So how does this compare to loans and equity? And basically, revenue-based funding comes halfway between the loan and the equity itself. And so revenue-based funding is similar to a loan in that it requires regular payments back to the investor. Now, it's different in that there are no attachments. For example, there's no personal guarantees, there's no physical collateral or hard asset collateral. Typically, revenue-based funding attaches to the accounts receivable and intellectual property, and that's about it. And that's why this is called risk-reward. It's similar to equity in that it has a lot of the risk-reward components. The greater the risk in the deal, the greater the reward in the form of a higher return. And so in the negotiation, if the revenues are substantial, they're reoccurring, they're under multi-year contracts, well, the risk that those revenues will go away is very low, and so the return is going to be less. If the risk is higher, well, then the return can be higher to compensate the investor for the risk that they take in. So it's halfway between loans and equity in structure. So loans typically have a cost of capital around 20% after all the fees are added in. And that depends upon the type of loan you get. Is it factoring? Is it a straight loan, an SBA loan? And then what kind of origination fees and other fees go into it as well. Equity funding also has a cost of capital. And let's say an entrepreneur raises $500,000 from investors and gives out 30% of the company. 5 years later, they sell the company for $10 million. That 30% is now worth $3 million. And so that cost of $500,000 investment was at a $3 million rate. Revenue-based funding, under the structures that we're proposing here, typically has a cost of capital around 25%. So if the deal is coming in and they're giving a 3x return on a $500K investment, then they're basically giving the investors back $1.5 million. That's about half the rate of what the equity payout to the investors would be, which is at $3 million in our current scenario. Of course, these numbers change quite a bit based on the individual negotiations. Some can negotiate smaller equity compensation to investors. Others have higher equity compensation to the investors. Loans come in many flavors and types that are out there, but they also usually come with greater risks as far as personal guarantees, hard asset, collateral, etc. But this gives you a flavor that, again, loans are on one side, equity is on the other side, and revenue-based funding is in between in what we're doing there. So I've been doing a lot of talking right here, and in a few moments I'd like to take some questions from you. So if you have a question, go ahead and start typing it in, and let's talk about what makes for a successful deal. So a strong management team with stable and growing revenues, that's what really does well with revenue-based funding. In fact, in any funding situation of any kind, the strong management team is almost always at the top of the list and is one of the most important things to look at, and that's no different here. The other thing to consider with revenue-based funding is careful thought given to tax implications. And the reason I say this is in an equity deal, investors, many angel investors, are simply used to writing a check, putting it in, and let's see in 5, 6, 7 years what happens. And there's nothing going to happen between here and there as far as taxable events, and so very little thought is given to that beyond it's just going to be a long-term gain, no problem. With revenue-based funding, there needs to be more thought to put into it so that the returns back to the investor are treated at favorable long-term capital gains and not short-term ordinary income. And there are different tax structures and banking structures that can be set up in order to facilitate that. And again, each deal is very different. Each individual and investor has a different situation, and so you have to adjust the different parameters in order to get a good tax situation for the investor as well. The other thing to consider is that in revenue-based funding, at some point there's going to be distributions coming back, so there needs to be an administration function. And by that I mean someone has to go in and distribute payments back to the investors. They have to check covenants that are in the term sheet to make sure the company is still compliant. It's often the case that it'd be useful to send out a report on how the company is doing. In many equity deals, I hear angel investors coming back complaining that they invested, but they just don't hear back often enough from the entrepreneur about how things are going, even though there was an agreement that it would come on a quarterly or monthly basis. It doesn't always happen. And so what works best in revenue-based funding is to put in some administration function where someone goes in and actually performs that program or service for actually making the dividends, cutting the checks, and making sure that everything is still in line. And that's an additional service or benefit to the investor who's now getting information about the deal, and there's some monitoring or oversight that's going into it that can help the process. So in summary, and then we'll look at some questions, revenue-based funding is a new way of funding early and growth stage companies. Companies dividend back a portion of the revenue until they repay the investors the expected return rate that's been agreed upon. And it works well with companies that are generating revenue, but oftentimes this works well with companies that have a great deal of sales going on, but they don't have a lot of hard assets. And when they go to a bank, the bank says, well, you don't have any hard assets, I cannot lend to you. And the entrepreneur doesn't want to give out equity, and so revenue-based funding becomes a good solution in those cases where it's what we call a cash machine. It's just flowing very well, but there's just not a lot of assets in the business to collateralize loans itself. And finally, and most important, is revenue-based funding aligns both the entrepreneur and the investor around the common goal of revenue growth. In many companies I've invested in, I've discovered that after a while, the entrepreneur is motivated for the revenue or the salary, and the investor is motivated for the exit of selling to another company, and those can become misaligned at some point where they're going in different directions. Here, in this case, with revenue-based funding, there's only one goal. The more revenue you have, the faster the investor gets paid back. The more revenue you have, the bigger the salary the entrepreneur can take home. And so with that, let's go and see what questions you guys have about this, and let's see what we can do to answer those here in the minutes that we have here today. So the first question is, do you have a list of revenue-based angels? And the answer is, I would say just about every angel I've talked to in the past year has gotten quite excited about this. Not every angel understands it. Not every angel can do a revenue-based funding deal as far as the mechanics go, but we are working on that aspect of it right now. We have a group of about 10 revenue-based deal leads that want to look at deals and want to lead the deals and want to go structure them and so forth. So there's a growing group of investors that are interested in this area, and with deal leads that have the right structure, right bank account, and the right coaching, they can certainly put these deals together at a reasonable cost. Let's go back up. How is the revenue taxed for the investor? Well, that goes back to the tax implications. If you structure this properly, the revenue that goes back to the investor should be as a long-term gain or capital gains and not short-term ordinary income. It's very easy just to put a contingent liability on the revenue going back or the dividend going back to the investor, and then the investor has a very poor tax situation on that. And that's what we've done, is put together structures to give the investor proper tax treatment. How is this the same or different as what Cypress does? I'd say Cypress is a group that provides revenue-based funding as well, and they do it at typically probably higher levels than what we are proposing to do it at. We typically do it at much earlier stage companies and at much lower levels. So I think it's very synergistic with what the other groups are doing, but we are trying to find a place in the market that is unique to us and that we can serve best. We have a software company in revenue with a business model at 50% gross margin. In the growth stage, now at 15% gross margin. Would this apply? Well, it depends upon what you mean by gross margin. If your gross margin is 50%, then revenue-based funding would be a good fit for you. If in your question 15 is really the gross margin, then it would not be a good fit. And so again, gross margin is simply the price you sell your product at, what it costs to make that product, and then all of sales, marketing, general administration is below that itself. So just to deliver the product, typically in software is above 50%, and so in general I'd say it's a good fit. I'll show you guys here in a minute. There's a place on our website. If you go to the Texas Entrepreneur Network website and you think you might qualify for RBF or you want to learn more, there's a button called Investor Engagement. So the Investor Engagement button on the Texas Entrepreneur Network website, you go there and you fill that out as an entrepreneur. Give us a little bit of detail about your business. We'll come back and be able to tell you if it's a good fit or not. Are usury laws a factor? And the answer is usury laws are a factor if you're doing any funding below $250,000. This is according to the state of Texas. If you are outside the state of Texas, you'll need to check your local state securities law, as it may be different. But in the state of Texas, if you are lending less than $250,000, you are capped at a rate of 18%. And so you need to be careful of the usury laws and make sure that what and how you're structuring the deal and how it's going forward is not afoul of the usury laws. Again, structuring the deal is very important in order to get proper tax treatment, and also in this case, make sure you're compliant with usury laws that we have. Next question is 50 to 100K revenues sound great. What is the opportunity for financing if such revenue is secured through one large contract that has been paid or at least partially onto such amount rather than hundreds of recurring revenue? Well, this is the key that comes into revenue-based funding is what is going to be the recurring aspect of that? What is the prospect of getting more customers to come and follow on? What is the prospect of this one customer with a 100K contract repeating the contract or coming further? So the more there is recurring or repeating in the process, then the more likely this will fit the revenue-based funding deal. There are investors that do the risk-reward and will ask for a very high return but put money in with the thought that you will find more customers, while other investors will look at that and say that's too risky of a deal and probably will not do it. So I think you'll find that there are some takers out there, but not as many as others. Next question is, are the distributions legally considered a dividend? Does a company get tax benefit of an interest-bearing loan? And the answer to both questions is it depends upon how you structure it, but in the structures that we are proposing, the answer is yes. We are trying to structure the dividends as a qualified dividend, so you would actually get that tax treatment on it. You can also set it up that it can be considered an interest-bearing loan if that's of an advantage to the entrepreneur. Of course, both sides need to be aligned. You have to do it one way or the other. You can't do both at the same time in this case. Each case is going to be different, and we'll have to look at it to see how to structure your deal. Next question is, have you had a good play in the medical software market? Any experiences that you can share? Well, in the medical software market, it's often a good fit in the sense that healthcare IT, low-end medical devices have reoccurring revenue, have disposable sales, have repeat sales. They have repeatable revenue streams that make it a very good fit. So I'd say in general, healthcare is a good fit. Biotech devices, therapeutics are not a good fit because they're typically pre-revenue for many years before they get to the revenue stage. So in general, I would say yes, but it will depend upon the details that you have there. I could get revenues up by spending more marketing dollars. This can be a variable. How is this handled? Well, essentially, the revenue or the funding that you're taking in is being applied primarily in sales and marketing, sometimes a little bit more in product development. But in general, if you got an efficient way of increasing sales by putting in more marketing, well, then that's a good use of revenue-based funds. There needs to be a connection between investing in marketing and a return of sales. And so a revenue-based funding group was going to look very closely at your lead generation, how many leads turn into sales, what are those sales worth, and how solid or how proven is that model. And if you have a very strong connection between investing in marketing and creating revenue some month or two later or 3 or 4 months later, well, then you probably have a good case for using revenue-based funding with exposure into the marketing, or use of case with marketing as well. Next question is, how many of these deals have you seen in Austin in the last year? Is there a minimum transaction amount or revenue? Actually, I'm learning that there's quite a few of these deals going on. They don't normally happen with the angel-funded deals because what you see in the angel rooms are typically equity structures. They're doing a swing for the fence and hope to be bought for 10x revenue or 50x revenue or what have you. So in the deal flow rooms that we normally go in, we don't see many, but when you get outside those deal flow rooms, you'll find that there's actually quite a few deals going on. And they're often the type of business where there's not going to be a big exit. And so they did not take the angel path, or they did not go through the formal angel group. They've got a product they want to sell. They need to finance inventory. They've got high velocity, but they don't have hard assets, so they can't get a loan. So there's quite a few deals out there as well. As far as the minimum transaction amount, there really is no minimum transaction. You can do very low-end deals. You do have to consider that there's legal costs to set this up. There's administration costs. And so as the deal goes below 100K, below 75K fundraise, you're going to be finding that the transaction cost is going to start to weigh heavily on the deal. Now, there are some deals out there, restaurant deals and otherwise, that sometimes do this on a simplified basis, but in general we're proposing doing this at the 250K level and up because we have a little bit of a heavy structure here in order to give the right protections and the right tax treatment to it. So the question is, can we go back to slide 1? Well, yes, I can go back to slide 1. Like I said before, I will record this and people can go back and look at this, but let's go back through, and if you want to look at the previous slides that we have, by all means, this is the first slide we had, which is what is revenue-based funding. This is what our outline was for the day, and this is probably the first slide that we had come into it as well. So next question, what if the business is something that got hit by the recession and needs funding to re-ramp up again? Well, for revenue-based funding, they're looking primarily at the revenue stream. They're not looking at the cap table. They're not looking at the equity. They're not looking at the buyout scenario at the end of the day. It tends to be a little bit more quantitative. It tends to be a little bit more about the revenue stream that's at hand. And to the extent that post-recession you have a growing revenue stream and that the money can make it back up, you may have a good argument for revenue-based funding. So as I said before, cap tables are not that worrisome for the revenue-based funders. What is a reasonable fee or percentage for administering revenue-based funding deals? Well, that's going to depend upon how much administration goes into it. And so we can talk offline about the different scenarios. In some deals, they've got many investors, they've got very complex banking structures, and they've got quite a few requirements from the investors as far as monitoring and reporting, and so those fees will be higher. Other ones have very simplified, just simply report once every 6 months. The funds can move very simply, and there's not a whole lot to it, so those fees would be much lower. How do current investors with a firm look at revenue-based funding for additional funding? Some investors are excited about that because there's no dilution. They, like the entrepreneur, if they put money in and a subsequent round comes up, they are subject to dilution. Other investors need to be wary that the margins are sufficient enough to support revenue-based funding. So after an investor has come in on the equity side, they typically are now on the same side of the table as the entrepreneur, where they want to give up less ownership, they want to have less dilution, and so they're looking more at that aspect of it. Next question is, approximately what are the transaction administration costs? Well, again, the transaction and administration costs are going to vary quite a bit on the structure and how much administration is going to go into it. We have some deals we're putting through the process right now, and I'll be glad offline to share with you what those specific deals were structured and what the costs were in those cases. And we're finding that after you get the basic term sheet up and running, and you can reuse it, the transaction costs start to go down quite a bit because you're reusing a lot of what you already have built up. You're not creating a lot of new term sheets or what have you. So if you do want to go into this, what you'll find is that there's very little information freely available on the web because there is a cost in both time and dollars to put these structures together, and that's what we've done here in our cases. Where does an RBF deal fall in the capital stack in terms of liquidation preference? My understanding is that hard debt to the bank comes at the top, revenue-based funding comes next, and equity comes at the bottom. So just like it came in the middle with cost of capital, so it comes in the middle with a liquidation in the event of a bankruptcy or what have you. So we'll have to check more details about specific term sheets where equity deal has a liquidation preference. Typically, if there's a sale of the company before the cap has been completely returned back to the investor, the remainder of what needs to be returned back has to come out of that funding or that buyout in order to pay back those investors, and that comes above liquidation preferences on equity, but we'd have to go look at specific situations in order to make sure that that's correct. Are there any other questions at this point? If you do, well, let me go and again encourage you to come back and ask for more information about your specific situation. So we have on our website a button that says Investor Engagement on the menu item. If you're an entrepreneur, fill that out, and we'll be glad to give you more information about how your deal may fit revenue-based funding. If you are an investor and you like to be a deal lead, or you like to do a follow-on lead in this case, there is a button on our website called the Connect program. And you can sign up there as an investor, and then we'll put you in touch with deals that you can actually go look at on the website. We do have a funding portal live right now for investors. If you are an accredited investor, you can go to our Texas Entrepreneur Network website, log in, and you can see several revenue-based funding deals that are ready for follow-on investment, and you can participate in those deals as well. Are there any other questions at this point? One more question has come through, and that is, does S-Corp work or structure has to be changed to an LLC or a, I guess it's a C-Corp? And the answer to that question is that, again, it's going to depend upon the tax structure or the implementation structure we put in there. There are some cases where you want an LLC, other cases where you want a C-Corp, and so it may be required to change it in order to make it work. One of the things you do with revenue-based funding is you typically create a additional entity, either LLC or C corporation, that both the investor and the entrepreneur own, and the revenues flow through that entity. There's a set of bank accounts, but there's a common entity where the accounts receivable and the IP are placed, and so as the funds go through it, at some point when it comes time to dividend back, qualifying dividends are declared by the board, and the investor starts to receive their returns through that joint entity. So there are LLCs that have to be set up. There are C corporations in some cases that have to be set up in order to facilitate this process, which is why a few moments ago they asked the question, what's the minimum transaction fee you can do? Well, you can do almost any fee you want, but realize there's a cost of setting up these structures and putting these transactions together itself. Are there any other questions at this point? Well, those have been great questions, and I appreciate you guys joining us today. As I said before, we will record this, and we will send this back out to you in a link later today, and place it on the webinar page of our website, so you can get that there as well. Thank you for spending your Friday afternoon with us. Again, if you're an entrepreneur, please go out to our website, log on to the Investor Engagement button, and tell us more about your deal, and we'll be glad to tell you more about revenue-based funding. So with that, one more question. Is it mandatory to wait a year to pay back, or can that start right away? The payback can begin whenever you're ready. We have deals that can pay back in 30 days, and we have deals that need a year before they can pay back. So there is no requirement. From an investor point of view, the faster you can start paying back, the more interested they are in the deal itself. So just to recap, we've got quite a few investors interested in revenue-based funding. Unlike equity funding, where it is quite a bit of a discussion and negotiation and relationship building process, revenue-based funding tends to be a little bit more of a quantitative approach. And if you have the sales, you have the team, you have the revenue coming through, you can find funding in some ways to be an easier process than the equity-based funding. I can't say it's true for every deal, but that's the experience we had so far. With that, we'll go ahead and sign off for now, guys. Thanks so much, and we'll talk to you soon.